Welcome, everybody. Thank you for joining us. Today, myself, Kevin McCarthy, and I've got Steve Albritton from Howard Capital, currently in Tampa, right, Steve?
Yeah, just north of Clearwater, Tampa Bay, you call it, home of the champion Bucks.
There you go. That's gonna be exciting times. Also, Stephanie is joining us. She'll be monitoring the questions and answers and the chat box. So if there's a question, if you didn't hear something correctly, if you have a question, throw it in the chat box or the Q&A, and we'll be sure to get those answered at the end. So let me share, I'm going to start the program, and I'm going to give control to Steve, and we're going to have this recorded. So I thank you for taking the time, and here we go. Well, today, this program is our winter webinar series. It is still winter, by the way. You know, my daughter's in Denver, but South Florida is not much of a winter. It was chilly the other day, right? We had a sweater weather. Anyway, this is number 3 of the 5 that we're doing. And so we're covering Vance Howard, Howard Capital's money management. And so today is the recap. We're going to cover a little bit about how we had Vance Howard himself live last night, and how we did not go through the slides. So today we're gonna share the slides with you, which is definitely nice. So today's our noon program. But as always, when investing, you have to understand that there is risk. So you need to explain, really understand what you're getting yourself into and how much exposure you have. Today, we're gonna talk about accounts that do have risk, but they have their own stop loss. They call it the Buyline, and I don't want to take any thunder away from that yet. I'm going to leave that to Steve. But as you know, that McCarthy Financial Group, we clear through Madison Avenue Securities, which is a uses Pershing company. We have many relationships with E-Trade, Fidelity, TD Ameritrade, different platforms. But when investing, you always want to know what type of risk you're getting into. And as you know, when titling an account, that could be more of legal advice or for your attorney to make sure it's a trust or a joint and how it's titled. And then sometimes it's an IRA, non-IRA, and the tax advice there. We're not tax advisors. We're not legal representatives. But in our practice, these 3 people in your life should be talking to each other. Your attorney, your accountant, your financial advisor should know each other and should have an open line of communication. And they should have one really serious interest in you to make sure they're doing the best for you. So without further ado, I'm going to stop the share and let Steve take over. Steve, you're up.
All right. Thank you, Kevin. As always, it's a pleasure to be able to present the Howard Capital story. And as Kevin said, we're going to kind of recap some of the things that Vance Howard, our founder and our chief investment officer, said last night during the call. We've also got kind of a special treat at the end of my session here, which probably go about 20, 25 minutes. Vance was interviewed yesterday on a cable news network before the opening bell yesterday, and has some very interesting thoughts on the market, on certain sectors in the market, et cetera. So hopefully y'all will enjoy that down the line. Kevin, are you seeing my slides okay? That's the first question. Are you?
Not yet.
Okay, sorry about that. I can see them on my end. So bear with me if y'all would please. Let me start the share. And bear with me. Okay, let's go full view. And let's do this. Okay. How are we here now? Full screen? Okay. All right, very good. So first off, wanted to kind of just lay the groundwork. Folks out there, you folks that were kind enough to tap in, you may or may not have heard of Howard Capital Management. So I'm just going to kind of lay out the facts, who we are, where we are. We're located in Roswell, Georgia, which is just north of Atlanta. 60 to 70 employees at our campus up in Roswell. Our company has been around, was founded in 1999. It's a long time ago, and we've been through a lot of different market cycles that has, tested our proven system called the Byline that we will talk about in a moment. Probably the most important question to ask when you're interviewing a money manager or finding out about a money manager like Howard is, how much money are you guys managing? What do you have under management? And the answer for Howard is we're approaching $2 billion under management. We're right about at 1.6, 1.7 billion under management. You know, that's a lot of money for sure, but it's not, you know, we're not a juggernaut in the industry like a Vanguard. We're not one of these huge, you know, mega companies that don't know who their investors are. We have a very, I'll call it a personal relationship with all of our investors and the advisors that we work with. And that's something I need to point out as well. We don't work directly with the public. We work only through independent advisors, just like Kevin, that are not beholden to any one company or any one mutual fund. Kevin's got anything he can, you know, he's not dictated as to what products he can sell. That's called independence. And that's the advisors, those are the advisors that we work with at Howard. So just kind of laying that out. This gentleman right here, Vance Howard, is our featured guest last night. Just very smart, entrepreneurial gentleman. He's a Texas A&M guy. I will tell you, you know, he's not a Brooks Brothers wearing suit money manager. He's from Texas. He drives a Ford F-150 to work. He wears boots and jeans, but man, is he an excellent money manager, and we'll get to his track record in a moment. But as I said, Vance started the company in 1999. He's been at the helm since, and you know, has been the guy that's really driven our philosophy at Howard Capital. And let me share that philosophy with you. We are not what's called a buy and hold money manager. The world is full of buy and hold money managers. In fact, probably 95% of our industry, Kevin, you might agree, is in that buy and hold mindset where, hey, look, we're going to build a portfolio for you, but it's not going to adapt to what the market is doing. So if we get a big drawdown in the market like we had back in 2008 or even last spring during the COVID drawdown, you know, hang in there. We're not going to go to cash or try to preserve capital. Just hang in there. Don't open your statements though. That's all we ask. You're going to come back. Everything is going to be fine. We don't subscribe to that at all. We're what's called a tactical manager. We make moves in our portfolios in response to what the market is doing. If it's doing well, we're going to stay invested, and we have a math-based, quantitative-based system that we use that determines what area of the market is working best. And that's where we're going to put our investors, whether that's technology, whether that's, you know, consumer discretionary, large cap, small cap. That's what we do when we're invested. We're picking the right sectors in the market to participate in. Where we're different than a lot of money managers is we're defensive. So we have a system called the Buyline, which I'll get into in a moment. It's been around actually before Vance formed Howard Capital in 1999. He was using it with his own private wealth and with some private clients with a company that he was with before he formed Howard Capital. So it's been around a long time. It's time tested, and Kevin will agree, hopefully, that it's worked very, very well in keeping our clients on the right side of the market, again, for over 2 decades. So that's kind of the overview of Howard Capital. This is the Buyline. This is the track record of our Buyline. And the 3 words that I always use when I'm describing what the Buyline is, first of all, it's an algorithm. It's a math-based formula that we've used, again, since even before the company was formed. But it's emotionless. It is without human emotion, the signals that are generated. It's repeatable, meaning it's done a great job over 20 plus years. And it's mechanical. And when I say mechanical, that means math-based. You heard Vance, well, you guys didn't hear it, but the audience last night heard from Vance over and over. We are a math-based investment management firm.
I'm here. I apologize. I had a code that wasn't allowing me to log in.
No problem, Vance. I'll hand the gavel over to you. And we've got about, what, Kevin, about 60, 65, 70 participants here. And anxious to hear you, Vance. So I'll pass it on to you.
Well, thank you. And I think I've got Kevin? I've got you, Steve, on the line. Is that correct?
Correct.
Okay,
Yep.
good. Again, I apologize for being a little bit delinquent hopping on here. I appreciate the opportunity to speak for 5 or 10 minutes about Howard Capital Management and what we do over here and how we're quite unique. I think one of the more unique things about Howard Capital Management is, to be quite candid, I am the largest client, and meaning that my money's traded right next to yours. So if you have a 40% gain one year, so did I. If you have a 10% drawdown, so did I. And so I am probably the largest client at Howard Capital Management. So my money's right next to everybody else. I tell people all the time that we're pretty good cooks, and I actually like my cooking. And so we eat our own cooking over here. It's an interesting thing. I had an interview this morning with one of the cable networks, and it was on reasonably early at the start of the morning bell. And they were asking me about the difference between value and tech, and why tech over the past couple of weeks had pulled back. And like I told the panelists, I said, we're very big believers in tech. We trade a lot of tech. We believe in a lot of innovative companies that are doing wonderful, wonderful things in the stock market. And there's so much money to be made, everything from Spotify to Zoom to Square to just a number of wonderful, wonderful companies. And she said, well, the value stocks are really doing well. And I said, yeah, they have for the past 4, 5, 6 weeks. Of course, they've really lagged for the past number of years. And I said, think about this logically with the value stocks, Walmart, Target, Procter & Gamble. I mean, how fascinating is the next Procter & Gamble's next fantastic soap going to be? I mean, how exciting is that really going to be for the market? Now, they're great companies. They make wonderful money. But is that really where the big plays are going to be to make a lot of money? They're probably going to be in such things as Tesla and Spotify and different innovative companies that are doing such wonderful work out there. And it's going to be very, very exciting over the next 3, 6, 9, 10, 12 years in the stock market. But one of the big keys about Howard Capital, and one of the reasons that I built Howard Capital, is that I would watch people back in my late 20s who were very successful, but they had a very bad habit of losing all their money. And a lot of it is they didn't have very good money management skills. When I developed the HCM Buyline, it was way back in the late 80s, and I met a gentleman by the name of Wayne Rainwater. And he was probably one of the best traders that I've ever met in my life. And he taught me to stay on the right side of the market, that was business critical. That, if the market's in a good bull market, everybody's really, really smart. But markets have a tendency, like 2000 and 2002, which went down for 36 months in a nasty bear market, which is 3 straight years of losses, which is very, very devastating to somebody's portfolio. But if you look at the NASDAQ 100 back from 2000 to 2002, you would have been down a whopping 64%. And that's just not something I can live through. If you're worth $10 million, I'm not willing to give $6.5 million of it away and end up with 3.5. That's just not the way that our firm operates. During the pandemic, the Byline was so spot on. We just made a tremendous amount of money. And, 2000, 2002, we were out of the market pretty much, I'd say 85% of the time. In 2008, one of the worst bear markets in history, we were out of the market 100%. We went back into the markets on March 31st of 2009, and every account we had was making a new high within 2 weeks. So there's something to be said for sidestepping very, very nasty bear markets. And one thing I'll tell you, and I know Kevin and Steve will tell you this too, I can't call a top or bottom. So, 5, 10, 12% moves in the account, those are just normal moves to us. And most of the times you need to be buying into them. When I write my weekly little article, The Wealth Watch, every Wednesday, I talk about this repeatedly, that if the Byline's positive and you get a 10% correction, that's usually a time you need to take any free cash you got and start buying stock, because usually it's a time that you're going to be able to pick up some really nice bargains. This tech pullback that we've had over the past 2 weeks, we've been buying into it the whole way, as it's been selling off and picking up some pretty nice bargains down here. But the Byline's positive. The Byline's got quite a bit of room before it turns negative. That's one of the things about the HCM Byline that we're really pleased with, is that it's not a very active indicator. You don't want to move money away from the market unless you absolutely have to. 2008, when banks were imploding, you had no choice. You had to move away from the market. The market was doing nothing but devastating your portfolio. But one thing I watched a lot of people where they make the most mistake is they allow their emotions to take control of the situation. Everything that we do at Howard Capital has to be mathematically based. Every decision we make has to be based upon math and has to be based upon odds. It can't be based upon how somebody feels. And if you're watching TV, you can watch the news media and they can absolutely scare you to death. Or they can get you so excited that, you start making decisions that aren't rational in that direction also. But like when the pandemic hit, and we started moving to cash the last 2 weeks of February. We moved a whole bunch of cash the first 2 weeks of March, not because we knew that the pandemic was going to be a horrible thing or mild, or we didn't know. What we did know is that math had turned negative and that we needed to move money away from the market because the mathematic was definitely pointing south and that there wasn't any reason to fight the tape. We were about 63% in cash in April when the market came down to what turned out to be a bottom. We went back into the market when the Buyline went positive the first 2 weeks of April. Now I got to tell you, it was a uncomfortable trade to move hundreds and hundreds of millions of dollars back into the market, including all of my money. But that wasn't what we're paid to do. We're not paid to feel at Howard Capital. We're paid to trade math, and the math pointed north the second week of April. Now you have to remember, back in March and April, you had the Imperial College that was sitting here telling us that we were going to have 12, 15, 18, 20 million Americans die of COVID. Now, that turned out to be completely wrong. We're at 500,000 people. If we would have been at 12, 15, 18, 20 million people deaths, you would see the S&P down 70% right now today. It would not be up. It'd be down 70%. Now, the Buyline would not have ever pulled us back in, but the Bylines gave us the math, that gave us the knowledge and the courage to come back in without any emotion tied to it. It wasn't a very comfortable move, but we had to make it. We're not paid to make decisions based on our emotion. We're paid to make decisions based on a mathematical equation. And that's what we did, and that's one reason we made so much money in 2020 during the pandemic. Also, during 2008, when the Byline gave us a new call back in the last week of March of 2009, it was incredibly disturbing. You had banks that were imploding. You had the Fed trying to put money into the system. You had unemployment up around 13, 14%. But the math said that the market was turning, that more buyers were coming in than sellers, and we took that trade, and of course, we made just a tremendous amount of money. So everything we do at Howard Capital has to be mathematically based. It has to be based upon odds. And that's exactly how we trade. I wish that we were so smart that we knew what was going to happen to the market next week or next year or next 5 years. I don't know. I don't have a clue. Now, the odds are the market in the 5 years is going to be higher. The odds are telling us that. But on a month-to-month or a quarter-to-quarter basis, you have to trade a non-emotional system, and you have to stay away from 2000, 2002. You have to stay away from 2008, and you have to make rational decisions during a situation like a pandemic. With the pandemic, and I've said it many, many times, this isn't the first pandemic we've had in this country, and it will not be the last. I think we've been very, 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 very fortunate that the pandemic we've only lost 500,000 people to this pandemic, because it has been a pretty devastating event. It could have been much, much worse. If the Imperial College would have been correct, it would have just been devastating. Fortunately, they were wrong. We've had some of the most tremendous amount of very, very bright, educated scientists who've created a vaccine in a rapid pace to help us curb this pandemic and to slow it down. But it won't be the last pandemic. There's another one right around the corner. Hopefully it won't be worse. We hope that it won't be worse than COVID-19, but we don't know that. But what we do know at Howard Capital is we do have mathematical systems that can gauge the market, pull us into cash and short-term bonds when we need to, and also move us back in the market at a rapid clip, so at least we can catch the turns and pick up great bargains when they happen. So we're a very plain vanilla firm. We're managing about $3 billion. We've got 3 mutual funds, 2 ETFs on the New York Stock Exchange. All 3 of our funds are 5-star rated, which is basically an anomaly. Very few fund managers can claim 5 stars at Morningstar in 3 separate categories. We can claim that. We're pretty pleased with it. Our funds have done very, very well. And that includes all of our funds went through the pandemic, so we made quite a bit of money in that. Again, we're a non-emotional shop. We take the emotion out of the equation. We want to trade things that are doing very, very well on behalf of our clients and try to make as much money as we possibly can when the Byline's positive. And I think this is a critical point too. When the Byline's positive and you want to be in the market, you need to rely on math to try to pinpoint where is all the action at. Well, one of the reasons that we could make so much money last year is, things like Tesla, things like Square, things like Spotify. the math was pointing us in directions of where all the action was. And that's where we want to play. We want to play where the action is, because that's when we make the cash register ring.
Vance, I really want to thank you for taking the time. I've got a couple questions for you. Folks, if you have questions, you can go through the chat box or the Q&A part and chime in there. Vance, one question for you. Why use a money manager? Why not use, the old Warren Buffett, buy and hold?
Well, I think that's an interesting thing. And I think everybody on this call has heard of a gentleman by the name of John Bogle. Has everybody heard of the founder of Vanguard? I'm just going to assume that everybody's heard of the founder of Vanguard. Well, the founder of Vanguard came out, and this was about a year and a half before he passed away, which he was a fantastic individual. He did a fantastic job for the investors in the market out there. But he stated verbatim, and I'll quote him, he said, there's going to be times when Vanguard loses 25, 30, maybe 40, maybe even 50% of your money in the next bear market. Well, I'm not going to sit through a 50% loss, and I love Vanguard. We use their ETFs. I'm not going to sit there and watch 50% of my money go away. I'm just not. And if somebody else is comfortable with that, they need to go and buy and hold, because the next pandemic, you may end up losing 50, 60, 70, 80% of your money. There's better ways to manage money. When the Byline's negative, for the love of Pete, move something to short-term bonds or to cash, and then wait for the market to reset and come back and catch these fantastic deals when they're on sale for 50 cents on the dollar.
Hey, Vance, I have a question, and I get this question every week from advisors. They look at Howard, they look at the success rate of the Buyline over the past 2+ decades, and they ask me, why don't all money managers have a system like the Buyline where they can go to the sidelines during these big, waterfall events in the market? Why does our industry still support the buy and hold methodology in the first place? Why don't other systems use, or other companies use, a system like the Buyline?
Well, when you look at it this way, with let's talk about Kevin, Steve, and Vance. We're all three on this phone right now. Well, let's think about this logically. I'm a $3 billion money manager. I can probably go to $9 billion, maybe $10 billion. Even at $10 billion, I'm extremely small. Think about what would happen if Fidelity or Vanguard or some of these other large companies decided that they want to go 10, 20, 30, 40% in cash. They would absolutely crater the market, and the SEC wouldn't allow it to happen. They just wouldn't let it happen. They don't have a choice. And when you look at things like Vanguard, that's their mantra, is just to buy and hold. And that's fine. That's a great tool. But for individuals like us, Steve and Kevin and myself, we have the ability, being smaller and more nimble, to take advantage of these moves that other institutions, they don't have the capabilities of taking advantage of moves like these.
Great.
So
yeah, go ahead. Sorry,
go
ahead.
Vance, let me ask you this. It's a two-part question. Does the math show a positive gains for 2021? And where would the action be now?
Well, like I said, the Bylines, we run the Byline on a week-to-week basis. We run the math every day, but it's run on a week-to-week basis, whether we're going to stay in the market or stay out of the market. The Byline, as it stands right now, is positive. The S&P is only up maybe 3%. Technology's down maybe 2%. Basically, you got a flat, we're going into the first quarter of the year. We've got kind of a flat exposure here. But one thing that we gauge a lot, especially when the Byline's positive, is cash buildup. And there's a tremendous amount more cash on the sideline than has ever been on the sideline in history. And let me repeat that to everybody that's listening. There's more cash on the sidelines right now than has ever been sitting on the sidelines in the history of the market. That means there is so much fuel out there that can be applied to this market to push stocks higher. It's unbelievable. Now, to have a quarter like what we're having now, which is kind of sloppy, there's nothing wrong with that. This is just the market moving around. It's doing its thing. It's like I say all the time, a marathon runner can only run so far and so fast before he has to, no matter how good a marathon runner he is, he's got to sit down from time to time. Well, the market's the same way. It can only run so far, so fast, where it just has to take a little Spanish pause, as we say in Texas. There is a lot behind this of buying power behind this market. So if you're calling, like I said, the Byline's positive. We're 100% invested. If you want me to give you my opinion, I think the market's going to be much higher by the end of the year.
That's great news. Vance, Steve again. You've been using this Byline, the proprietary algorithm, for a long time, even before Howard Capital was formed in 1999. The market's changed a lot in the last two and a half decades. Has the Byline changed, the underlying, formula in the Byline? Has it changed along the way?
Absolutely, it has. Anytime you can make anything better, you absolutely should make it better. When we started out with the Byline back in the late 80s, early 90s with myself and Wayne Rainwater. Now, Wayne Rainwater had been using it for 30 years. His calculation's different than what it is now, but we actually would run the HCM Byline back in the late 80s and 90s on a big, cheap tablet. And every day we'd take a calculation by pen and paper and mathematics and write it down. Now, with the advent of quantitative math and the advent of computers that we have, we're able to really game the market. We've made some terrific strides on gaming the market, on efficiency, on ways to come out of the market more efficient and ways to come back into the market faster and with more strength to capture those turns. I mean, the quantitative math that we're using over here at Howard Capital is amazing. I've got 9 programmers working right this minute trying to make situations better for myself and every client that we work for. I want to game the market as much as I can. I want to become the casino that has a huge winning percentage with huge rates of return.
Makes sense. Thank you.
Vance, a couple more questions here just came over with the chat. Has there been periods when the Byline was disappointed? And if so, how long did it take to come back?
Well, anytime that we've made the Byline better and better and better. Now, one thing that we did learn back in 2018 is that quantitative, meaning that computer-generated trading, is starting to dominate the market. The people that are listening to this call, you're not trading against Bob Smith or Steve or Kevin or Vance. You're trading against a computer all day. Over 85% of all trades now are computer-driven. That's the reason that we use our quantitative systems, all computer-driven. So we've got to be faster out, but we've got to be faster in. And we've also got to pinpoint where the activity is, because if you would have been in value stocks in 2020, you actually would have been down 12%. If you were in high growth stocks like we were, you were up. You had an amazing year. But yeah, we've had times when we've had to adjust and we've had to improve, but that's just evolution, and everybody should strive to get better and better every single day, and that's what we try to do over here at Howard Capital.
Okay. Two more. I've got 2 more questions here, Vance. I really appreciate this. Does Howard Capital have a succession plan in place of you retiring, stepping down?
I'm 57. I feel pretty good. Yes, we do, though. I've got 2 young gentlemen that work with me on the quantitative side. If something were to happen to me, they're able to pick up the quantitative system and run with it. They actually sit on our index board that we have for our 2 ETFs. Very, very sharp guys. So yes, if something happened to me, like I said, we're quantitatively driven. We're not driven by one individual. We're driven by math and by what happens with the systems that we've built.
Okay. I think you answered this question. The last one is, what is the overall assessment of how the market will do this year? I think you have already answered, but if you could elaborate on that and your final thoughts, Vance.
The Byline's positive. I would be in this market. As long as the Byline stays positive, we're going to be adding money. If you want my guess on where the market's going to be at the end of the year, I think we're going to be higher. I think that with this $1.9 trillion stimulus package being thrown into the market, that's going to give a lot more money flowing around to perk up the economy. Things are going to open up a lot quicker than we all think. Herd immunity in a lot of states, there's 7 states now that we predict, and herd immunity has already taken place. In other words, like South Dakota, I know that South Dakota is a very small state, but the quantitative measures that we're looking at, they were having 2,000 COVID cases a day in the very end of January. As of yesterday, they had 9 a day. So herd immunity, a lot of these states are starting to take place. The larger states will take a little bit longer, but we're going to get opened back up by May, June, or July. This economy is poised to have a huge explosive growth in the economy, and that's only going to lift stocks.
Vance, awesome. I appreciate your time. I want to say thank you so much for joining us. I know you're busy. So Vance, thank you. Zach, thank you. Steve, thank you so much. People, don't go anywhere. I want to share a couple things with you that's happening here at McCarthy Financial Group. Vance, thank you so much for joining us.
Thank you, Kevin. Thank you, Steve. And thank you, Zach. And everybody on the call, thank you for being on the call. Stay safe, and we look forward to helping you in the future.
Everything we do is based on what our system is telling us what to do and where to go when we're invested. And there will be times where we will go to cash. We will take our client accounts, sell out the positions and put them in the safety of cash or treasury bills while the market is suffering a huge drawdown. What you're looking at here is the S&P 500, this jaggedy line graph you're seeing here. Not going to get into every dot on the chart here, but safe to say, enough to say that the red dots, hopefully you all can see that, where you see the reds and the dates down here at the bottom, where you see the red dots, that's where we took started to reduce risk in our portfolios. Typically, Howard Capital will take 2 steps out of the market when the market begins to show severe weakness. So when it's time to get back in and the Byline signals all is clear, the market's healthy again, we're going to get back in all at once. Why do we do that? Why do we take 2 steps out typically and 1 step back in? Getting out, we want to make sure that that signal is solid, that it's a positive, accurate signal. If we had just 1 signal and we took everything to the sidelines and maybe that signal wasn't correct, 100% accurate, we don't want to be on the sidelines when the market then recovers. We want to make sure that our signal holds, so we take 2 steps out, usually over a period of days or a couple of weeks between the 2 signals. Getting back in, we want to capture as much as the uprise in the market, or the upsurge that happens inevitably after one of these big drawdowns. I'm going to point out, hopefully you all can see this, but 2008, everybody remembers 2008, what happened. Severe drops in portfolios, some up to 50%. Well, if you look at our 2008 signals here, and that's the red indicator right there, you follow the date on up, you're going to see one date, September 24th, 08. That's when we left the market. Now, I just told you we take 2 steps out, right? You don't see 2 dates there. You see 1. That's because this was a kind of an anomaly. It was a very fast, very rapid, very strong drawdown in the market. And the Byline, the signal was 1 day apart. So we just put the 1 date here, September 24th, 08, as to when we got out. We got back into the market March 30th of 09, right down here, and enjoyed a very nice, uprise in the market, a surge up in the market after the big 2008 drawdown. I'm going to put your eyes on this last part of the graph here. That's last spring, when the whole COVID thing came down, when the market, suffered greatly for a short period of time. That was, by the way, the fastest and strongest drawdown in the shortest period of time in the history of the market. And so we left the market. Here are our 2 dates when we left the market, March 10th and March 12th. It's 2 days apart, so we put both dates there. There's our 2 steps out. And then we got back in just about a month later, April 14th, 2020. But look what happened in between. We got out and we got back in. Pretty severe drawdown there in 2020. We avoided that drawdown, as we did in 2008, and as we did, quite frankly, back when the tech bubble burst, 2000, 2002. So this is the tried and true system that has helped, again, our clients keep on the right side of the market, preserve capital during these big drawdowns, and it's been a great system to be able to talk about, for all these years. Last thing on the Byline, and Kevin, please weigh in if you have any thoughts on the Byline. You're very familiar with it as well, but this is not a hair trigger system. In other words, if, like Monday, when the market dropped, and especially in the NASDAQ, a normal correction is typically not going to trigger a Byline signal. A normal correction, they're natural and healthy. That's a natural part of the market. The market, like a marathon runner, has to take a breather every now and then. And that's a completely natural thing. During a normal correction, and let's call it an 8 to 10 to even 11% drawdown in the market, we're going to go in and we're going to buy things on sale, just like Warren Buffett does. That's what we do. It's the 20, 25, 30, 35% drops in the market, even 50%, that we're avoiding by use of this Buyline. So that's the nature of our system. And it's, again, emotionless, math-based, and repeatable over time. So it's a great thing to talk about. Kevin, any comments or thoughts on the Buyline?
Yeah, something I do a lot, try to explain in my presentations when talking about the Byline is you see these triggers and these points, they're spread out. This isn't day trading. We're not trying to, pick the winner of today. That's way too emotional to get involved. And dice and lucky and gambling go on with those combinations. Whereas this is, again, that mathematical equation when you should be in the market. Vance, and nobody can call a top. No one's going to call a bottom, but we're just trying to get most of the upside and less of the downside to smooth out that ride. You got to be in it. Investing is a long-term investment. This is not, for, hey, I need this back in 30 days. This is not the place to be. This is for longer term holding. And if you have the time, you will be rewarded. History has always told that.
Excellent observation there. And I'll kind of add a prologue to what Kevin just said. If you look at these time periods, and here's one between, October 20th of 2011 is when we got back in after leaving the market a little bit during this big drawdown here, but you don't see any reds or greens in this 4-year period right here. But you do see ups and downs in the market. We stayed invested through these, corrections in the market, and we were rewarded for it. Again, it's the giant, I call them waterfall events. They look like waterfalls. These big events that we had in 08, last spring, 0002. We spent back in 0002 when the tech bubble burst, we spent a good deal of time in cash while, our investors' neighbors were down 50% on all the technology stocks they owned. We were in cash most of that time. So there are a lot of tactical managers that do what we do. There are not a lot that have done it for as long as we've done it. Again, going back to 99, a lot of them came out of the woodwork after 2008. But that's one of our strengths. That's this long-term track record. So I've got a little exercise here, and this is kind of this is taken right off our website. And I'm going to spend just 2 or 3 minutes here kind of explaining how well the Buyline works. And we actually have a tool, Kevin uses it all the time. It's called the Byline Illustrator on our website. Instead of taking you to the website and showing you, I've peeled off the information and put it on these slides. But what this exercise is, it's a what if scenario. It's a hypothetical scenario saying, okay, let's take a scenario where you have $100,000 and you invested it in the S&P 500, going back, and you invested it on January 1st, 1997, and you just held that in the S&P using what's called the SPDR, SPY. That's an ETF that replicates the S&P 500. So you invested $100,000 with the SPDR, SPY, and you held it going all the way through this year. And I'm going to show you what that looks like. There it is, 100,000 invested. You had some ups and downs along the way, but let me move this. The bottom line is, at the end of the line, your 100,000 with the SPY ETF grew to almost $700,000. That represents a 588% total compound return over that period of time. What we're going to do now, again, in this what if scenario, I'm going to pick a mutual fund, any mutual fund that's been around a while. I'm going to pick a good one, a fund called Growth Fund of America. It's an excellent mutual fund. You all may have heard of it. It's widely used in 401ks and a lot of investment programs. It's been around a long time, but it is a buy and hold fund. They don't go to cash like we do. They do have active management where they've got, human beings deciding like we do when we're invested, where we're going to be invested. but they're a buy and hold fund. So we're going to show you now what that 100,000 would have grown if you'd have bought that particular mutual fund that has no relationship to Howard Capital. It's just a really good fund. I'm going to show you how it did. 100,000 invested, held it. You didn't do anything with it. You just held it like the industry wants us to. And you know, it did a good job. It outperformed, you know, the S&P 500. So now the numbers are your 100,000 grew to 1,063,000. Very good. You know, if I was a American funds wholesaler, I'd end the presentation and move on. A very good fund. But now we're going to show you, had you had the benefit of the Byline signals that we just talked about, I'm going to show them to you again. In other words, you bought the fund, $100,000 back in 97. You sold it here. You bought it back here. You sold it again. In other words, you obeyed the signals that the Byline generated with that one mutual fund. I'm going to show you how much better you would have done. It's pretty remarkable. That's the green line. That's that same Growth Fund of America with the Byline. And look at the difference. Now your 100,000 is almost at 3.5 million, as opposed to 1 million with just buying and holding the fund. So that's a demonstration. Again, it's on our website. You can pick any fund that's been around for 15, 20 years that went through 2008 and hopefully went through 2000, 2002. Put it in there and see how that Byline would have reacted with that fund. So Kevin, I know you use this tool, correct?
Yeah. And you chose a fund that I run up a lot on. Raymond James is a big believer in that American funds, and again, it's done extremely well. But if you don't know, you don't know that you could be doing better in the same exact fund with the Byline if they had that Byline.
And that's the thing, Kevin, we don't, I work with advisors like you, every day. And I always get new advisors that say, hey, I love that Byline, but I build my own portfolios for my clients. Can I buy the signals of the Byline so I know when it's, the answer is no. We don't sell the signals. The only way you get the Byline is through investing in Howard Capital, investments. And that's our segue to the next kind of section of the presentation. This is, I would say, Kevin, correct me if I'm wrong, but your favorite way to have client accounts at Howard is through what's called separately managed accounts, which are just brokerage accounts that we're managing, correct?
That's correct.
Yeah. So we've got a whole lineup. I'm not going to go through all of them today, but that's really Kevin's job, is picking which one of our, 9 portfolios that we have. They all do different things. And here's the rest of them. And within each one of these portfolios, we have, sometimes 3 or 4 different, I'll call them flavors, from conservative all the way through aggressive. So if you're a conservative person, but you like this portfolio, let's say this Viper 2, we've got a flavor for a conservative investor and we've got one for an aggressive investor. So that's the way we do it. Again, that's Kevin's job, determining your risk tolerance and then matching you up with one of our separately managed accounts. We call them SMAs.
Yeah,
so
I do like that, because a lot of times when we're picking portfolios, and I always lead, again, dividend driven is probably where my lead goes. Your ALP series, which you're going to talk about next, is another favorite of mine. But having that, how much exposure you want to equities, do you want, if it's that 60, 70% or 30, 30%, that's where that conservative balance to growth come in play. And again, knowing what you're expecting and getting yourself into. So again, 25 different accounts to choose from between the 9 portfolios. Again, gives you diversification, and that's what you need, with that. And we've been using the E-Trade, which allows us up to 3 different models per account. So it's been very advantageous for us.
Excellent, excellent. So yeah, we're going to kind of shine the spotlight on one particular portfolio. It's called ALP. We love acronyms at Howard Capital. ALP is Active Lifestyle Portfolio. Again, it's one of our portfolios that you all have access to through Kevin. But the growth version of this ALP active lifestyle portfolio. It's been around since October of 2002 with real client accounts. So we have a long-term, this is our flagship portfolio. I think you would agree, Kevin, right?
Yes.
This is the one, even though you love the dividend strategy, which is awesome as well. This one's been around, you know, again, since '02. And it's just really, it's a great indicator of how well we've managed money. This is one portfolio that we're making changes, you know, not every day, not even every month, but you might open up your statement one month and you might see us in technology, you know, overweighted in technology. The next month you might see, there's convertible bonds in here, or there's small cap or large cap or value, or we have the ability in this model, as we do in some other of our models, to rotate. It's called sector rotation. And that's how this has been managed, again, since October of 2002. Let's look where the rubber meets the road here. This is a graph showing, going all the way back to October of 2002, the inception of the ALP growth. The yellow line here, orange line, represents the S&P 500. The purple line, that's the ALP growth. It's a pretty nice spread, beating the S&P net of fees. I'll add net of fees. We've beaten soundly the S&P. So what this chart is showing, 100,000 invested here, grew all the way. It's 1,000%. That means your 100,000 grew to 1,000,004, just over 1 million. With the S&P, it grew to 554,000. So we basically doubled the performance of the S&P by avoiding these big drawdowns. You see that drawdown right there in the S&P? Well, go up here to the ALP growth. What does this flat line mean? That means we went to cash. So we didn't have this downward movement in the portfolio. Your capital was preserved. We re-entered the market. And look at that. We had some nice growth that happened. And we re-entered the market with a bigger bucket of money than the person that had this big drawdown and then got, you know, enjoyed the upsurge after that. But that's the way it works. If you see these flat lines along the way, the most current one back in, you know, last spring for about 4 weeks, we stayed on the sidelines and you had this big drop in the market. It doesn't look that big now because it's a long period, but it was a big drop and we were in cash again for about 4 weeks. So just a great representative example, net of fees, of how well one of our portfolios is done. Anything to add, Kevin, or move on?
Well, you say net of fees, so I always have to clarify.
There you go.
Is what the client would be receiving. The fees are already taken out.
That's correct. Yep. Very good. I'm just going to throw this out here. We're one of the few companies out there that can manage someone's 401k. And Kevin has the ability to do this as an advisor using Howard Capital mutual funds, which are all 5-star. We heard Vance talk about our funds last night, our mutual funds. We have 3 mutual funds out there. They're all 5-star, which is very, very difficult to do. And I can't think of another money manager whose entire offering of mutual funds is all Morningstar 5-star. It's almost unheard of. But anyway, bottom line, what we can do, we can go in if your 401k has a self-directed brokerage account window. Howard Capital, you can have Howard Capital sign trading authorization. We'll go in and we'll place the trade for a model, if you will, that consists of our 3 mutual funds in that self-directed brokerage account. It's just been a wonderful way to help people with what is often their biggest asset is their 401k. Not going to spend any more time on this, but if a lot of you folks probably don't have a 401k anymore, you may be retired, but certainly you know folks that do, either children or friends. This is a way to really get professional management, again, with that stop loss protection of the Buyline to avoid those 08s from happening over again. So I just want to spend a couple of minutes on that, Kevin. I hope that was okay.
Good.
Yeah, very good. we're at the point now, it's 12:30 on the dot. I'm going to read this disclosure. It's going to take about 20 minutes. I'm kidding. I'm not going to read this disclosure. As Kevin said, every, investment has risk. Just because we have a Buyline that has protected our clients from these major drawdowns for over 20 years, there's going to be movement in your portfolio up and down, hopefully more up than down. But there is risk. As I define risk as volatility in a portfolio. Again, Kevin will guide you on which portfolios have, an appropriate amount of volatility given your risk tolerance.
I've got Vance on the screen.
You got Vance on the screen. Very good. All right. So we're going to roll this video. Again, just a real quick setup. Vance was interviewed on this network. It's called Cheddar. I've never heard of it, but apparently it's quite popular. They have a morning bell show, just like CNBC and all the rest. And he was interviewed yesterday morning. Does everybody know what happened in the market on Monday? We had what the media is now calling a tech wreck. I mean, it was a horrible drop in the technology sector. And it had everybody saying, this is it. It's the end of technology. It's finally giving up some gains, and it's not going to be a good investment going forward for a little while. Well, you know what? Vance said the opposite, and you'll hear him talk about technology here in a moment. But he said this before yesterday's opening bell. Right after this interview, what happened? The NASDAQ had a huge day yesterday, and we're back in positive territory for the technology sector for the year. So let's roll the tape. Again, 6 minutes, and we'll circle back at the end.
Our markets desk, we're joined by Vance Howard, CEO and portfolio manager of Howard Capital Management. It's great to have you with me this morning, Vance. So we do see this tech-heavy NASDAQ showing a pretty strong recovery today. Do you think the worst is behind us, or does this sector still look volatile to you?
Well, first of all, good morning. How are you today? And I think the tech sector is bottoming out right here. I mean, this is just a classical technical pullback in the tech sector. We've seen a rotation from high quality value stocks. Last year did very, very poorly. Tech did very, very well. We saw a rotation out of tech into those type of stocks. But in the long term, technology is just going to do very, very well. And so we look at this as a buying opportunity. We were buying into it. Our proprietary indicator, the HCM Byline, is positive. As long as it's positive, any pullback's a buying opportunity to us. And you start to look at technology and what's really going on here, it's incredibly exciting, all the different aspects that they're being built. And I know that the epicenter stocks, the big value stocks for the play for the last, 30, 40, 60 days. But if you look at it logically, with Procter & Gamble and Walmart, or do you want to own Spotify and Square and Tesla? I mean, for the next 12, 24, 36 months, where are you going to get the most bang for the buck? Well, we're looking at Tesla and Square and Spotify and companies like this. Because, is Procter & Gamble really going to invent the most exciting bar of soap next year? I just don't know. I don't think so.
I think the expectation, though, is just that the recovery will start to broaden out, and that some of these industrial stocks and consumer staples, for instance, certainly the staples that might have done well in the immediate aftermath of the pandemic, they have been underperforming of late. And as a new normal sets in, we could see a more broadening out of the rally when it comes to Procter & Gamble and some of these other stocks. Vance, do you like the tech sector as a whole, or do you see winners and losers within it? Apple, for instance, is that a company that you like or dislike?
Well, everybody loves Apple. How can you not like Apple? It's a big part of the S&P, big part of the NASDAQ 100. But yeah, we are seeing a broadening out, and that's incredibly healthy. I think it's a great, you're going to start to see small caps and mid caps start to do very, very well. Some of your international ETFs and international holdings should start to do very, very well. The broadening out is a very healthy situation, but I think to discount tech would be an unwise move. I think you still need to be overweight tech going forward for the foreseeable future. But there's some great value stocks out there that were really beaten up during the pandemic that are going to come back strong. And so, yeah, there's opportunities there. But I think being overweight those type of stocks would not be the best course for any investor right now. I think the pullback that we've seen in technology has just been a great gift for people to come in at a little bit lower prices who believe in these stocks 12, 24, 36 months out.
Vance, let's talk about this stimulus package. We'll show our viewers a really helpful full screen as to what exactly is in this package that the Senate passed over the weekend, and now the House is returning to look at this week. Checks of $1,400 for those making up to $75,000 and a check for each family member of $1,400 plus a child tax credit per child as well, with that amount ranging on the exact age of children. We did see some of the stimulus money throughout this pandemic, Vance, over the past year come into the stock market. Once this package does pass, as everyone expects that it will, do you think that that will be a boom for the market? How much of that is priced in, and how much could the market benefit from $1,400 checks reaching people's bank accounts?
It's going to be a great boom for the market. I mean, it's a huge package that's being thrown into the economy in a tremendous, in a lot of different areas, not just the stimulus to individuals of $1,400. But, you know, one thing that I did kind of find funny is one of the senators from Massachusetts was stating that she was really upset that when they got the last stimulus check, that people were actually investing that money. And I thought to myself, how illogical is that? Instead of taking your money, your stimulus check, and buying a pair of tennis shoes and a t-shirt, you actually put it in Tesla or Spotify or Square, and to enhance your long-term viability as far as retirement goes. So I think you're going to see some of this money come into the stock market too. And you're also going to see it really uplift the economy, a big infusion of cash into this economy. I think it's going to be a big boom. Is it slightly priced in? Absolutely, it's priced in. I don't think anybody doubted that this was going to get passed. I think everybody knew that it'd get passed. But you know, going forward, I think this is just a vast amount of money that's going to be thrown in the economy and push things forward for the next 1, 2, 3, 4 quarters.
How much of a concern is inflation for you, Vance? Because even the Fed Chair Jerome Powell last week said, and this is why we saw the sell-off, that we could see temporary inflation once the economy opens up. Do you see that putting downward pressure on some of these tech names?
It did on a short-term basis. But, you know, inflation is going to pick up for the next 1, 2, 3 quarters. But think about this logically. Back in the pandemic, if all our manufacturing plants shut down for 2 months, 4 months, 6 months, that didn't mean that your dishwasher and your washing machine didn't break, because they're a piece of equipment. They go away. They need to be replaced. New construction, you have to buy new pieces of equipment like a refrigerator or dishwasher also. So when you look at just basic supply and demand, yes, the next 1, 2, 3 quarters, we're going to see a modest amount of inflation. But long term, I don't see that being an impact at all. And I think inflation will wash its way through as you start to see manufacturing pick back up. Even me, with some of the properties that we own, we were at 2, 3 months out being able to order and get a good refrigerator to come in after one had died and needed to be replaced. So it's a short-term effect. It won't have that big of an impact on the long-term or the intermediate-term aspect of the market.
Quickly, Vance, are there any risks that you see to the stock market? And if so, rattle off a few of them.
Overregulation, high taxes. And those are two things that are risks to the market that I think could affect things. I don't think they're going to raise taxes very, very quickly due to the fact that we've got a lot of unemployment. We need to work through that. We need to work through getting this economy back on track. So, but those are the two issues that do concern us a little bit: overregulation and high taxes. That can slow things down.
All right, Vance Howard is the CEO and portfolio manager of Howard Capital Management. Vance, thanks so much for joining us this morning. We appreciate it.
There you go.
Good stuff. All right.
Yeah.
We didn't get them live today, but we got a recording of them from yesterday. That's awesome.
Yeah.
All right. Let me do this. Share and from. Thank you for coming out today. Today was all about one of the money managers that we work with, and we've had a great relationship for the last several years here. I love doing these educational events. Event number 4 of our winter series is 2 weeks from now, Tuesday at 5:30, and another replay at noon, like today, Wednesday. That's the March 23rd and March 24th. I'm inviting Carmen from Axio, and he'll be educating us on bank structured notes. So that is 2 weeks out, and some other events that we're having. Mark your calendar. It falls on the last Wednesday of the month, but it so happens to be the last day of the month for March 31st. I have fun with this one. It's virtual bingo over Zoom, and you know, some technical difficulties always happens, but I'm going to be sending out an email on how to open up the Zoom bingo and get your card. And as I read the numbers off, and we play 4 or 5 games, there's winners, there's prizes. It's a social event. It's fun. So mark your calendar for March 31st at 5 o'clock. Another social event every Thursday. So tomorrow at 10 a.m., we have a Zoom meeting. This is with Diana. She does the chair yoga. You are not standing on your head. You will not hurt yourself. You're sitting in a chair. She does a little meditation, she does a little stretching, and she does the Savasana, which is my favorite part, to kind of disconnect and really regroup yourself. It's a 40-minute practice every Thursday at 10 a.m. I hope that works for you. If you ever wanted to, if you don't want to get on, if you ever wanted to try it out, she put up a class on our YouTube page. So we are on all the social media pages. We've got a Facebook page for the company. We've got a LinkedIn. We've got Twitter. We have Instagram, and we have YouTube. So we are on all the social media. Stephanie helps us out putting all that. Now, the girls in the office, which is Diana, Vivian, and Stephanie, put together a book club. So the first meeting is April 2nd. By that meeting, you have to have already finished the book. The book is authored by Larry Loftus. The book is The Princess Spy. They're going to do a Zoom meeting, and on Friday, it's the first Friday of each month. There'll be a new book announced next meeting, which is April 2nd. But you should have already read this book, and you just share your thoughts on it. This is by the girls. It's a social event, and it's a good time. So there it is. The crowd goes crazy. My wife loves that, by the way. I want to thank you for coming out today and sharing your time with us. I hope this was an educational event. I hope you come out to some of the social events. We're always here for you. We work for you. So if there's anything you need, reach out to us. We're here for you. Steve, thank you. Stephanie, thank you. Everyone, be safe and have a great day. Bye-bye now.
Thank you, Kevin.
Thank you.